Hey guys, it's Sasha and I want to do a video today, a special video on trading stocks when you have an 8 to 5 job. And I got this from somebody posting a question from the members, doing a comment for me. And again, I just want to really thank you guys for following me and also posting the questions, and I'm glad I can help you out. I just want you to really start thinking about things a little bit differently. So if you don't mind, I'm actually going to read the question and then we'll get into this, because this is going to be a little bit more in depth, and I'm going to share with you something very special that I normally don't share with people. You're going to take a look a little bit into how I do some of my retirement trading for the 8 to 5 job. So if you have an 8 to 5 job, this will be perfect for you. So in either case, the question goes like this. First of all, thank you for the good work and amazing videos you share about trading. They are very helpful. I'd like to know your opinion and advice on investors who can't watch the stock market closely due to a full-time job. I work from 8 to 5 p.m. and there's no way for me to watch the stock minute by minute. So obviously day trading is not an option for people like me. Is swing trading the only option for me? What about portfolios, mutual funds, index funds, ETFs? Any advice would be helpful. Thanks a lot in advance. Okay, so pretty much what I want to mention to you is, first off, don't day trade at all. I talk about trading is definitely don't day trade. Day trading is for crumbs. It's when the market has volatility. It's great for people that are watching the market and they go in and out. But you're not going to be making a significant amount of money, and that's stressful. You need more commission fees that eat up your account. So I really don't recommend day trading. I fully recommend swing trading or long-term trading. It's key. It's going to save you on the commissions. It's going to also allow you to have a peace of mind, and you'll have a lot bigger runs, massive. Whereas day trading, you're trying to fit in the 6.5 hours in a whole day to squeeze in all your trading. You know, whereas swing trading, you might let a stock run for weeks and months at a time, making those huge gains. So if we look at, even the Dow Jones or the diamonds here, and we look at it running from, let's say, November all the way up till now, that's a swing trade right here that you want to capture. Same thing with even Boeing. Look at it from here. From March, April, May, June, July, August. That's a run from 79 to 109. That's what you want. And this is the weekly chart. You know it's a weekly because here's the weekly. If you do it the monthly, you can do it the monthly. But again, these are the runs that you want to capture. It's those. You're waiting for the charts to set up, and then you're doing the run when it goes on breakouts. Okay? So if you're day trading, you're just playing around with little ticker symbols, and you're not going to be making a lot. So in either case, also the weekly and monthly recaps or the monthly runs are a lot stronger. So the support and resistance are more concrete. That means you have a less chance of things failing. I'm not saying they won't fail. I'm saying it's a better chance for your things to succeed in your favor if you're doing the right things, such as watching the price action, even on a nightly recap. So if you have a job, you go home and you watch these trends at night and you do your research and you see that things are hitting, but they're not breaking out. So maybe watching it on the weekly, even if you caught it somewhere midweek over here, let's just say after things are breaking out right here, and you caught it even late by 3, 4, 5 days, and you bought it off your cell phone or tablet, you're still going to have a very good run. Look at that run right there. Okay, so each one of these represents a week because it's on the weekly. Okay, so definitely I don't recommend day trading. It's very crumb-like. It's not recommended. You might have days or trades where you only trade for 2-3 days just because the run didn't work. So you do have to pay attention, especially initially. But definitely focus on more swing trading or long-term trading. Now, on the next part of the question, basically they asked about the ETFs, mutual funds, and index funds. When it comes to portfolio or mutual funds, it can be safer, and I say can. They move differently and they don't have earnings specifically, so it's easier to predict the trend in some cases. I want to talk a little bit on Apple that just happened not too long ago. We were looking at this stock And let me just remove some of these trend lines here for you so you see what happens. When you have stocks that are moving and they're stock specific, you have different things that happen, like these gaps over here. Stocks gap up. They can be for the good or they can be for the bad. Now, index funds, portfolio funds, all those things, they are a little bit safer in that you do not have these types of things that happen as frequently because they don't really have news. What they do is they try and follow the market, kind of like as a way to, they don't try to, you know, predict the market. They don't try to do anything beyond by just showing you and reflecting exactly what it is. So when you have the diamond ETF, the Dow Jones, it mimics the Dow Jones. That's what it tries to do, and that's the diamond ETF. When you have the SPY, it's the S&P 500 ETF. Are these any better than stocks? They can be safer, but they do still gap. They do still gap. When the market gaps, they will gap, and this can be an area of concern. So it does make it a little bit safer because they don't have any specific news or earnings, but you do still have the market risk. You do still have the trade risk because you're in the trade. When you're in the trade, you do have the economic or the global risk. So there's still a few risks out there, but you know, you're not going to have anything specific to the SPY, such as, you know, the S&P 500 news coming out, unless something like a disaster happened with the S&P 500, but usually that's rare. So in either case, these are safer bets, but it just comes down to risk and what you're willing to trade and how you're willing to trade it. They're safer than stocks, but they move a lot slower. So that's kind of the downside. So if you go to like the EEM right here, you know, the emerging markets, again, you trade these the same type of way as the other things. Now you can create these trend lines here and watch the breakout and see what happens. You know, obviously you would have missed the run here, or you could have bought at support this level and let it run there. So a couple ways, or you could have played the trend. You know, bought at the lows here, sold at the highs, you know, and then maybe sold short and then went down here and then bought and so forth. So again, it depends on your time horizon, what's available. Now, I do recommend definitely to do your own trading. I don't recommend giving it to a broker because, as I always mention, the broker is, number one, most concerned about themselves, as any human person is. Think about it when you're in the jungle. I love the jungle examples. Everyone is always concerned about themselves. So that's the first thing. So Lord of the Flies, remember the book Lord of the Flies. The second thing they're going to be concerned about is their company. They're going to be worried about their company, and then maybe you, and then maybe your money. So in the end, they're not going to care too much about you. So if you don't have great availability for time in order to trade between those trading hours, then you know your best bet is to trade off of your cell phone or tablet, or call in the trade when you see it on your cell phone or tablet or something like that. Go to the bathroom, check it. If you're just starting out, that's the way you do it. You know, check things like that. If your company or job doesn't allow it, you're going to have to figure something out. You know, I don't know. You can sell automatic triggers in order to buy things or sell things, but I don't really recommend that because you have to learn how to spot price, action, volume, and behavior. That's the key. Okay, I'm going to emphasize again, price, action, behavior, and volume. Those are the key things. You got to learn how to do that very, very good, and then you'll know when to enter, because otherwise you're going to be entering fake outs and they're going to psych you out. Those managers, hedge fund people, they'll buy millions of dollars of shares just to flip that rug from underneath your feet, thinking, oh, the market's long, and they're going to suck you in. And this didn't hit me till 7 to 10 years later in my trading career. So I was one of those people as well. So don't worry about it too much, but that's just the nature of the game. You're going to have to pay your dues. Now, the third option, I'm going to share with you guys something special now. The third option, and this is for advanced users only, and I'm going to stress it, for advanced users only if you have an 8 to 5 job, is to put on option spreads to collect theta, which is depreciating contracts, or in order to make money every month. See what happens with an option contract, and think of it like a coupon. When a coupon has is a deterioration of time value, it's got that expiration date. Same thing with an option. When you give someone the option to buy your house for $10,000, you pay them $10,000 and you say, hey, I want the option to buy your house for $150,000 rather than $100,000, because you might think, oh, there's some development going on, and the option contract lasts for 6 months. So for them, it's great. They make $10,000, and if you don't buy it, then they keep the $10,000. But if you do buy it, you're able to buy it from them for more money, but that means the house prices are going to be going up. So they want to do that because they know that development is happening. But you as the house owner may not know that. So that's just the basic premise of options. But here's what I want to share with you is options do deteriorate, and you use time value in order to leverage options. So in my trading account, and this is again just going to share with you some very, very brief things. I don't want to overshare with you guys too much on this because otherwise it may get confusing. But basically what we do in some retirement accounts, or what I do for my stuff, I don't trade for anybody really unless it's family, but you can create these things called calendar spreads. So you sell the option in the front month, and you buy another one for protection in the next month. So on this one, on this little contract right here that I got going on Wynn Resorts, actually, the price can go from 142 to 158. And if we look at our diagram at Wynn, basically I'm over here, so it can go from about 142 here to 158, a little bit up there, right? So the price can fluctuate anywhere between here, and that if the price fluctuates within there, I make money. How much money is going to hit this red line? Okay, this white line is the current date. The red line is the expiration date. Basically, because I'm selling something, but I bought something in the other month, in order for protection. This profit line graph start rising day after day because options deteriorate. So when you're selling contracts, you're basically selling it in order for it to deteriorate. And this is just a calendar spread. If you want to look it up and research a calendar spread, they're also known as binomial options, which people try to make it sound like, oh, you'll make a fortune binomial options, but you don't. You still got to know how to trade price, action, and volume. You got to know about intrinsic values of options, and you got to know about implied volatility. And you can't be trading these options, because what people try to do is sell you this course and these courses that are, one DVD or 5 DVDs that are just about binomial options, saying you're going to make a fortune, because you're not. The course I'm working on for this stuff is about 10 to 15 DVDs. It's like 20 hours of material just to trade binomial options, because you can get screwed and you can lose a ton of money with this. But let me show you the power of this. Basically, the stock can move from this, here's the price over here, 143 to about 157, and I still make money. As the date moves forward, and I'm just moving it here on the estimation program, I start making more profit, and options deteriorate quicker towards the end of the expiration time. So here it is. It's moving quicker and quicker and quicker, and towards the end already, you can see if the price hits at 142, I'm basically breaking even. But as it gets into 144, I'm up $600. As it gets to 146, I'm up $1,300. If the price is here at 149, it's $2,000, and this is just on a few contracts here and there. So you can see the price changing right here near my mouse, that it can basically land anywhere here, but you got to know how to play these. So I don't recommend you do this, unless you really know, first off, price, action, and behavior and volume. And number two, you got to know some stuff about options. Now, I will have some courses coming out later that are very in-depth, something that people don't share with you guys. I've seen on the market, and I've studied all of them, but people just don't share those kind of things, just because it just takes a lot of time. And for me, I think education is one of the most important things, because our education system sucks, and you need to really learn how to trade accordingly and trade properly, rather than just, hey, let me show you some strategies and then this is what worked for me and it might not work for you. So I'm getting in depth on some material here shortly, but it just takes a lot of time to build it. But in either case, that's how these option spreads kind of work. But again, I don't recommend you trade these unless you know what you're doing. But I just wanted to show you an insight. So what happens is you put this on and you let the price fluctuate here and there. When things get to an edge over here to the right a little bit, you start making adjustments sometimes. And actually I don't want to share with that too much, but let me just share with you an Apple position. You start making light adjustments over here, and you might put on different contracts to help balance and hedge your risk, because it always comes down to risk. So again, this, in a few days you make $200-300. It's not bad for the stock not doing anything and you not having to worry about it. So anyways, that's a little insight of how you do some trading to make money every month for advanced users only. And I'm going to try and put together within the next few months a course about that. I definitely have to put together some other course material that first talk about the price action and behavior and volume first. And I might make that available in the members section. But if you don't trade 8 to 5, or if you have a job from 8 to 5, this is how you do it. Trade off the cell phone first or tablet. Definitely don't day trade. Swing trade or long-term trading is key to everything, not just here or there. It's everything. Learn about price action, volume, or behavior, because I wouldn't have put on those spreads even on the options if I didn't know price action or behavior. Portfolio or mutual funds, ETFs, they can be better because they don't have the earnings and stuff, but it's not any different, and you might miss huge moves because they usually move slower. So again, kind of up to you. You have to talk to your financial advisor, this and that. I'm not registered or anything like that. So and for advanced users, I shared with you something different that I normally don't share with. It's the option spreads to collect that money every month. It can be golden for I do those for my retirement account because it's a lot safer, and I'm not going to risk my money in order to to invest in the market, because they talk about only invest what you can lose, and I don't want to lose anything. I don't want to lose any money whatsoever. I don't want to lose $1, but it does happen. So you just have to prepare yourself, and you have to manage your risk. So in either case, sorry this was a longer video, but I just wanted to answer that video in depth and share with you some little bit of strategies. They're not secrets or anything. They're just making you look at the bigger picture. And I don't know where you're at in your level. I don't know where you are specifically in your trading career. You might have 1 year, you might have 5 years. So this could have been basic stuff, this could have been more advanced stuff, but it just shows you a little bit of a bigger picture when you have the right education, when you have the right knowledge, the things and possibilities you can do. So, for example, when I go on vacation or something like that, you can put on these option contracts or option spreads. So we'll talk about when. And, you're out there on the beach relaxing, and, the stock's bouncing around here between 4 or 5 different points, and you're still making money. That slowly deteriorates. White line goes to the red line, and you're making money. So again, that's not how most people trade. That's usually for advanced users, but you can't be doing that until you really understand the action, the behavior, and the volume. All right, I hope this was helpful. I hope you continue to study, to learn, to broaden your horizons, and continue making money from money. Keep evolving, keep growing, and keep learning. And then eventually, I hope that you contribute back to others around you. So my main thing, my focus is the financials. I also enjoy the business-to-business ventures. So those are my key things. I do a lot of the different marketing and stuff like that for people, do different seminars. And I just only hope that I can help you in your own life, so that way you can contribute back. So I always say, do what you love, contribute to others, and most importantly, live life abundantly. All right, have a great day.